Welcome to the Deep Dive, the show where we try to cut through the noise and get straight to the insights. You might not realize it, but the Australian banking sector, it's a truly fascinating beast. It's mature, incredibly concentrated, and absolutely crucial to the national economy.
It really is. Systemically important, as they say.
Exactly. We're talking about an industry where the big four banks alone hold something like, what, 72% of all banking assets?
Around that, yeah. It's a huge concentration.
Think about that for a second. You probably interact with one of these financial giants almost every single day, right? Whether you're, tapping your card for coffee or managing your mortgage, but do you really know what intricate forces are driving them?
Probably not the full picture, no. There's a lot going on beneath the surface.
So today, we're pulling back the curtain on one of those titans. Westpac Banking Corporation, ticker WBC.AU, Australia's first and oldest bank. Our mission for you today is to unpack its incredible journey through a really critical period from 2022 to 2024.
A very dynamic few years for them.
Definitely. We're going to reveal how this institution is navigating this complex landscape of, macroeconomic shifts, intense competition, and a massive internal transformation. It's really a story of a banking giant moving from fixing some pretty significant past problems.
There were some significant ones.
Right, to investing heavily, very ambitiously in its digital-first future. Okay, let's unpack this. We're talking about a banking giant with over 200 years of history.
Indeed. And what's particularly insightful here, I think, is that Westpac's recent trajectory, it truly encapsulates so many of the broader themes impacting the global financial services industry right now.
Like what specifically?
Well, the absolute imperative of digital transformation, the ongoing pressure from regulators that never goes away, and the relentless pursuit of efficiency in what is a highly competitive market, it's almost like a microcosm of the challenges and opportunities facing all major financial institutions today.
Absolutely. So let's start at the beginning, or maybe where Westpac is today, with a glimpse at its core business model. And here's where it gets really interesting. Not just any bank, but the original Australian bank.
That's right.
Westpac was actually established way back in 1817 as the Bank of New South Wales. Imagine, it's been around since before Australia was, truly a nation in its modern sense.
Quite a legacy.
For sure. As a long-standing member of the Big Four, it's truly a pillar of the Australian financial system. Now, when we say Westpac operates as a universal bank, what does that actually mean for its business model? How does it make its money?
Yeah, that's a fundamental question. A universal bank like Westpac, well, it offers a really comprehensive suite of banking and financial services. It caters to a huge array of customer needs, from individuals like you and me to small businesses, large corporations, even governments. Its primary source of revenue, its kind of bread and butter, if you will, is net interest income, or NII.
NII, okay.
This is basically the difference between the interest it earns on its assets, think predominantly the loans it makes out, and the interest it pays on its liabilities, which are mainly customer deposits, your savings account, for instance.
Right, the spread.
Exactly, the spread. Think of it as the basic engine that powers any traditional bank.
So it really needs both sides of that equation to work well. People taking out loans and people putting money into deposits. It's not just about loan books, then.
Precisely. While NII is fundamental, Westpac also supplements this with non-interest income. This is crucial.
Okay, so what falls into that bucket?
Well, it includes things like fees for various services, credit card fees, account keeping fees, that sort of thing. Also commissions on product sales, revenue from its wealth management and insurance products, so they have sold some of those off, and income from trading activities in financial markets.
Right, so it's a more diverse stream of income.
Exactly. These diverse non-interest income streams are crucial because they provide resilience. They diversify the bank's revenue base and make it less susceptible to fluctuations driven solely by, say, interest rate cycles or just intense lending competition.
That makes sense. Sort of hedges their bets a bit.
It does. So when you hear the term Big Four, you're now getting, hopefully, a deeper understanding of the sophisticated internal workings of one of these giants. It's not just about taking deposits and making loans.
That distinction makes perfect sense for building a robust financial institution. Now, Westpac's been on this journey of significant strategic simplification recently. You mentioned they sold some businesses.
That's right, 10 non-core businesses.
10. So they've really been trying to sharpen their focus. What does this new streamlined structure look like now? And how does this sharpened focus actually help them compete more effectively?
This simplification is a really critical piece of their whole transformation story. Westpac is now organized into 5 core divisions. The consumer division is, well, by far their largest in terms of earnings. It serves around 9 million customers across Australia with everything from transaction accounts to home loans.
9 million.
Yeah, it's huge. And this is where their multi-brand strategy really comes into play. It allows them to reach about 12.7 million customers overall through well-known brands like Westpac itself, of course, but also St. George, Bank of Melbourne, Bank SA, and the specialist mortgage lender RAMS, alongside their wealth platform BT.
Ah, so if you're a customer of St. George or Bank SA, you're actually a Westpac customer, even if you don't always realize it. That's a clever way to segment the market.
It is, absolutely. And it allows them to cater to different segments of the market with, slightly different offerings and branding. Then there's business and wealth. This division supports small to medium enterprises, commercial businesses, agribusinesses, and also high net worth individuals through private wealth. Then you've got the Westpac Institutional Bank, or WIB. This provides sophisticated financial services globally to corporate and institutional clients. They have offices in places like New York, London, and various Asian financial centers.
So a global reach there.
A decent global reach, yes.
Yeah.
Then there's Westpac New Zealand, which is a systemically important bank in its own right over there. It serves about 1.5 million customers and holds roughly 19% of that market, making it the third largest bank in NZ.
Right.
And finally, group businesses. This basically handles the centralized support functions like group treasury and core technology operations.
That's a pretty comprehensive structure, even
Right.
after simplification. But what was the real strategic benefit of selling off those 10 non-core businesses? What did that sharpened focus actually achieve for such a massive institution beyond just, getting rid of assets?
Well, the strategic benefit is immense, really. By divesting those non-core assets, Westpac achieved a kind of dual win. First, they freed up significant capital, nearly 0.6% of their core equity capital, or CET1 ratio. That's a substantial boost to their financial strength.
Okay, nearly 60 basis points. That's not insignificant.
Not at all. But perhaps more crucially, it freed up invaluable management attention. Think about the complexity of running 10 extra businesses.
Right, less distraction.
Exactly. Less distraction from peripheral ventures and much more concentrated effort on improving their primary banking operations, where they actually have competitive advantages or where they need to shore things up. It's all about allocating resources, both capital and people's time, much more intensely on their core services and market positions. And that directly impacts their ability to compete more effectively and build a stronger, simpler bank.
And that strategic refocusing leads us perfectly into understanding how they stack up against their rivals. This simplification helps us understand where they're choosing to compete. So how does Westpac compare within that fiercely competitive Big Four oligopoly?
Well, Westpac holds a pretty formidable market position. They're generally seen as a strong number 2 overall in Australia. As of, say, September 2022, they commanded about 21% of the mortgage market and roughly 20% of household deposits. Very solid shares.
Okay, number 2, who are they usually battling with for that top spot?
They typically compete directly with Commonwealth Bank, or CBA, for retail dominance. That's the constant battle for the everyday customer mortgages, deposits, transaction accounts. However, a competitive landscape, it has its nuances. While Westpac is strong in retail, National Australia Bank, NAB, historically leads in business banking.
Ah, right. And you mentioned Westpac is targeting that area.
Exactly. Business banking is a segment Westpac is now aggressively targeting for growth, trying to eat into NAB's share. Meanwhile, ANZ Group Holdings, or ANZ, has a more developed institutional banking franchise and a broader international footprint, particularly in Asia. So they all have slightly different strengths.
And CBA. They always seem to get a lot of attention, often seen as the market leader. Why is that perception so strong?
Yeah, CBA is indeed widely acknowledged as the market leader, especially in retail banking, and critically,
The tech.
their digital technology and innovation. This technological lead is a really key factor underpinning the significant valuation premium CBA commands over its peers. Investors value that edge.
Right. So what does this all mean for Westpac then, this competitive dynamic?
Well, it means this isn't just about market share percentages. It's about the type of market share they hold and, perhaps more importantly, the efficiency with which they operate. Westpac's strategy now seems less about pursuing a radically unique direction and more about frankly, flawless execution. They need to close that efficiency and capability gap, especially with CBA.
So it's about running a tighter ship, basically.
Exactly. Their success really hinges on whether they can truly modernize their systems. That's the big Unite program will get to improve operational efficiency and defend their core franchises against these very strong, sometimes more specialized competitors. It's a race for relevance and efficiency, really.
It sounds like Westpac is in a constant battle on so many fronts, both internally and externally. Let's shift our focus now to those external forces shaping the entire Australian banking sector. Starting with the shifting sands of the macroeconomic environment. The period from 2022 to 2024 has been, well, to put it mildly, pretty volatile.
Absolutely volatile. The Reserve Bank of Australia, the RBA, in response to that post-pandemic inflation spike, embarked on a really aggressive monetary tightening cycle. They lifted the official cash rate from near zero all the way up to a peak of 4.35%.
Yeah, that was fast and furious.
It was. And this had a significant dual effect on the banks. Initially, it was actually beneficial. It expanded their net interest margins, their NIMs, because banks could reprice loans upwards much faster than they reprice deposits.
Ah, the lag effect.
Precisely. However, over time, it also significantly increased funding costs for the banks as deposit competition heated up. And crucially, it placed immense pressure on household budgets as mortgage repayments just soared.
Yeah, you certainly felt that if you had a mortgage.
Oh, absolutely. So it created this delicate balance where those initial NIM gains were quickly eroded, or at least pressured, by broader economic stress and rising funding costs. We are now in a phase where rate cuts are widely anticipated, probably starting sometime in 2025, as inflation moderates. And that, again, will shift the whole banking landscape.
So initially good for bank profitability, but then it kind of squeezed both sides. Their funding costs went up, and their customers had less disposable income. It's a delicate balancing act indeed.
And you mentioned rational competition earlier within this oligopoly. Can you elaborate on that, especially how banks navigate this intense pressure without triggering, say, a full-blown destructive price war?
Yeah, it's a key feature of oligopolies like the Australian banking sector. Competition is intense, particularly in relatively similar product categories like residential mortgages. Everyone wants market share. So banks compete fiercely. They offer incentives, cashback deals, slightly better rates, you know the drill. But generally, they tend to avoid truly destructive price wars that would severely erode profitability for all the players involved.
So they push, but not over the cliff. Kind of. It's a strategic dance. They push for market share, but usually without completely cannibalizing each other's margins to the point where nobody makes money. And this whole context where these national-level interest rate decisions by the RBA directly impact your mortgage repayments or the rate on your savings account, it really shows how closely linked the banking sector is to the everyday consumer. And it shows how banks have to carefully manage their pricing to retain customers without just giving away the entire shop profit-wise.
Speaking of stability, Australia's banking sector is often praised, isn't it, for its robust regulatory framework. Let's talk about that regulatory shield, maybe sometimes a sword, with APRA requiring banks to be unquestionably strong.
That's a crucial point, yeah, and definitely a pillar of Australia's financial stability. Australia has one of the most stringent prudential regulatory frameworks globally, overseen by APRA, the Australian Prudential Regulation Authority. And that unquestionably strong standard, it's not just a catchphrase. It means banks must hold capital well above the global minimum requirements set by Basel III.
How strong are we talking?
Well, to give you some numbers, as of June 2024, the industry's aggregate common equity Tier 1 capital ratio, that's a core measure of financial strength, basically high-quality capital that can absorb losses, was 12.7%. That is incredibly robust.
Okay.
It represents huge buffers against financial shocks. At the same time, their liquidity coverage ratio, or LCR, was 133%. That significantly exceeds the 100% minimum requirement, meaning they have substantial liquid assets readily available to meet their obligations, even under severe funding stress.
Right, so these aren't just abstract figures. They represent real, immense protective layers ensuring the stability of the whole system.
Exactly. The regulators are very focused on preventing failure.
So those numbers are genuinely impressive, indicating a very secure banking system overall. But beyond just financial strength, capital, and liquidity, what else are regulators like APR focusing on now? I feel like I hear more and more about non-financial risks.
You're absolutely right. It's a significant shift in regulatory focus globally, not just in Australia. While capital remains paramount, a key trend is the increasing emphasis on what APRA and other regulators call non-financial risks.
Okay, what does that include?
It covers a broadening range of areas. Think operational resilience: can the bank withstand disruptions? Data security, protecting customer information. Cyber attack preparedness, a massive one these days. And even the management of climate-related financial risks.
Climate risks, how does that fit in?
Well, regulators see potential future losses stemming from both physical climate impacts, like damage to properties, securing loans, and transition risks, like businesses failing if they don't adapt to a lower carbon economy. So, why are these non-financial risks becoming as critical as traditional financial metrics like credit quality? Because a major cyber attack, a systemic operational failure, or even unmanaged climate risks down the track could have devastating financial consequences.
Right, it could erode public trust, impact systemic stability just as much as, say, a wave of bad loans.
Precisely. And you also have ASIC, the Australian Securities and Investments Commission, maintaining a very aggressive enforcement posture on conduct and compliance. So this means banks aren't just managing money anymore, they're managing these incredibly complex digital ecosystems and a whole universe of ever-evolving threats.
It's a much broader definition of risk than we might typically think of for a bank.
Okay.
Okay, so despite this regulatory strength and focus on stability, competition remains absolutely brutal. Let's dive into those specific battlegrounds where Westpac and its peers are really duking it out: mortgages, business lending, and deposits.
Yeah, and what's fascinating here is how the competition plays out differently in each segment, really illustrating the dynamic pressures Westpac faces. Let's start with home loans. This is the primary battleground for Australian banks. It's the biggest part of their loan books. Westpac's market share was around 21% as of the first half of 2025.
Still number two, roughly.
Roughly, yeah. While their mortgage book grew, pretty much consistent with the overall market growth, the entire sector faces severe, and I mean severe, margin compression.
Why so severe? Just too many players chasing the same loans.
Pretty much. Intense price competition. Banks are essentially accepting lower profits per loan just to maintain their market share, or maybe grow it slightly. It can feel like a race to the bottom at times, especially when refinancing activity is high.
That's tough. So they're growing their volume but making less on each individual loan.
Yeah.
That must put pressure elsewhere. What about business lending? You mentioned that's a strategic growth area for Westpac.
Business lending is indeed a key strategic growth area, and they've actually shown some strong momentum here recently. They hold about a 16% market share as of H1 2025.
Okay.
But crucially, their portfolio grew by 14% in the first half of 2025. That significantly outpaced the broader market's growth of around 9.2%.
Wow, 14% is strong growth.
It is, and it reflects their concerted effort to capture market share in a segment that, as we said, has historically been dominated by NAB. It's a deliberate strategic pivot, trying to move away from being quite so reliant on just the hyper-competitive mortgage market.
Recognizing the potential for maybe better margins or stronger customer relationships in the business sector.
Potentially both, yes. Higher margins, stickier relationships, perhaps more cross-selling opportunities.
Okay, and the third battleground, deposits. That's where we, as customers, are always looking for the best rates for our savings. How competitive is that space right now?
In deposits, Westpac held about 21% of household deposits as of H1 2025. Again, a very solid share. But with the rise in interest rates over the last couple of years, competition for customer funds has become incredibly fierce.
It's because savers actually have options now.
Exactly. Customers are becoming much more sophisticated, much more active in managing their money. They're shifting their savings out of low-rate transaction accounts and into higher-yielding term deposits or online savings accounts. You've probably done it yourself.
Guilty as charged.
Right. And this trend directly increases the average cost of funding for all the banks. It puts further pressure on those net interest margins we talked about.
So it squeezes them from the other side, too.
Precisely. So the core insight here, the big picture, is that Westpac, like its peers, faces this kind of structural margin squeeze. Fierce competition hits profitability from both sides, lower lending spreads on mortgages, and higher funding costs for deposits. This makes extreme cost control and finding those diverse non-interest income streams not just, strategic goals on a PowerPoint slide, but absolute necessities for survival and maintaining profitability.
That paints a very clear picture of the twin pressures on margins. In this kind of environment, digital capability must be absolutely vital. Let's talk about the digital arms race and how Westpac is positioning itself, especially with all the fintech disruption happening.
Oh, digital capability isn't just an advantage anymore. It's a fundamental competitive imperative. It's table stakes. The quality of a bank's mobile app and its online services is a key driver of customer acquisition and maybe even more importantly, customer retention. If your app is clunky, people will leave.
Yeah, loyalty isn't what it used to be.
Not at all. Westpac has recognized this and is investing heavily. Impressively, its mobile app was actually ranked #1 in Australia by Forrester in late 2023. That signals a significant improvement in their customer experience, which wasn't always seen as their strength.
Okay, #1 from Forrester, that's quite an achievement. What else is part of their digital-first strategy?
Well, it includes some pretty ambitious goals, like developing a fully digital mortgage application process. They're aiming to reduce approval times from days, potentially weeks, down to as little as 10 minutes.
10 minutes for a mortgage approval.
That's the goal. Imagine contrasting that speed with the traditional paper-heavy back-and-forth process. It's a potential game changer for customer convenience and also for the bank's own processing efficiency.
A 10-minute digital mortgage approval is pretty groundbreaking if they can pull it off consistently. What else are they doing on the tech front to stay competitive?
Well, a big piece is they've forged a 5-year partnership with Microsoft. They're migrating key platforms to the Azure cloud. This is absolutely central to modernizing their underlying infrastructure, building scalability, and enabling faster innovation.
Moving to the cloud, like most large organizations are doing.
Yes, it's essential. And in response to the rise of these agile, non-bank competitors and fintech disruptors, think buy now, pay later services like Afterpay that really took off. Westpac launched its own installment payment feature called PartPay.
Ah, trying to compete directly there.
Exactly. It illustrates the ongoing need for these incumbent banks to innovate and adapt, not just to compete with the other big banks, but to fend off entirely new players who are often born digital and don't have the legacy systems baggage.
Right. You've probably used a banking app today, so
Yeah.
think about how much that experience influences your choice of bank, your satisfaction. It's this constant evolution, isn't it? Not a one-time fix.
Absolutely. Standing still is going backwards in this space.
So we've covered the strategic positioning, the competitive landscape, the external forces at play. Now let's dive into the financial performance, the cold, hard numbers that tell Westpac's story from 2022 to 2024. Let's start with revenue and margins, and it looks like, as you said, a bit of a roller coaster for net interest income, NII.
You're right. It has been a very dynamic period, reflecting both those big strategic shifts like the divestments and the broader market forces like interest rate changes. If we look at FY22, Westpac's net operating income actually saw a decline. But this was primarily due to a substantial fall in non-interest income.
Why was that?
Mostly lost earnings related to those businesses they had divested, like their Australian life insurance arm. When you sell a business, you lose its revenue contribution.
Makes sense.
At the same time, their core net interest income showed only modest growth, maybe 2%. And even that was largely offset by that intense margin compression happening in the mortgage market. So FY22 was really a year where they were fundamentally restructuring and feeling the effects of that.
So a tough year for overall revenue, largely because they were shedding those non-core businesses. But then FY23 marked a strong turnaround, didn't it? The numbers look much better.
Absolutely. FY23 marked a significant recovery. Net operating income climbed strongly, up to about $21.6 billion. And this was driven mainly by a robust increase in net interest income, which rose 7% to $18.3 billion.
What drove that NII recovery?
It was fueled by that dual benefit we discussed earlier. First, expanding NIMs, especially in the first half of the year as the RBA rapidly raised interest rates. That allowed the bank to reprice loans upwards faster than deposits.
The lag effect again.
Exactly. And second, solid growth in their average interest-earning assets, about 6% growth. So more loans and wider margins, at least initially. It demonstrated a strong rebound in their core banking profitability following that divestment phase.
And what about FY24? And we're seeing estimates for that now. How did those trends continue? Did the momentum keep up?
Well, for FY24, NII is estimated to have grown further, maybe to around $18.8 billion. This reflects continued disciplined margin management and steady growth in their loan book.
Okay, so NII is still growing.
Yes, but non-interest income was somewhat weaker again, particularly in the second half of FY24. And this was mainly due to lower income from their markets division, their trading activities.
Right. So the core insight here is that while Westpac showed good resilience in its core NII engine, that divestment strategy and tricky market conditions created a bit of a volatile path for overall revenue. it became even more heavily reliant on that core banking engine.
That's a good summary.
Let's zoom in on that net interest margin, NIM, because you mentioned it's perhaps the most critical driver of profitability for Australian banks. What have the key trends been there, given all that volatility with rates and competition?
Yeah, the NIM has indeed been highly sensitive to market conditions, really showcasing that delicate balancing act we keep coming back to. In FY22, the NIM actually fell down to 1.87%. This was primarily due to that intense mortgage pricing competition, but also a strategic decision to hold more lower-yielding liquid assets for regulatory purposes.
Okay, so pressure in FY22, but then it bounced back.
It did. In FY23, this trend reversed sharply. The NIM expanded to 1.96%. The rapid increase in the RBA cash rate allowed the bank to reprice its lending book upwards, while the repricing of its deposit book, as we said, lagged behind. This led to a significant widening of spreads, especially in the first half of that financial year.
That's the lag effect you mentioned earlier, where deposits take a bit longer to catch up on pricing.
Yeah.
A temporary benefit for the bank then.
Exactly, a temporary tailwind. But in FY24, the NIM largely stabilized, maybe averaged around 1.93%. However, the underlying trend towards the end of the year, the core NIM, excluding some benefits, was actually lower, maybe around 1.83% in the second half.
Why did it come off the boil again?
Well, largely offset by those persistent negative pressures we discussed. Intense mortgage competition still squeezing loan spreads, and customers getting smarter and shifting their funds from low-rate transaction accounts to higher-cost term deposits.
So the squeeze was back on.
The squeeze was definitely back on. So the core insight here is that Westpac's net interest margin is this high-stakes balancing act. It's directly tied to the RBA's every move, but simultaneously getting hammered by relentless competition and changing customer behavior. For Westpac, managing sustainable margins is like a continuous tightrope walk.
That's a very clear picture of the pressures on revenue and margins. Now let's look at the other side of the coin. Credit quality. How resilient has Westpac's loan portfolio been through these economic shifts, especially with higher rates? Are we seeing any emerging signs of stress?
Yeah, this is a really important area. And overall, Westpac's loan portfolio has shown remarkable resilience throughout this period, which also reflects the underlying strength of the Australian economy post-COVID, particularly low unemployment. In FY22, for instance, they recorded a very low impairment charge. That's the money set aside for expected loan losses. It was only $335 million, or just 5 basis points, 0.05% of their average loans. Really minimal losses.
That's an impressively low figure, especially given the pandemic uncertainty just before that.
It really is, and it speaks to the underlying health of the loan book at that time, plus all the government support that was around. Impairment charges then began to normalize in FY23, showing a modest increase to $648 million, or 9 basis points.
Still pretty low historically, though.
Still very low, yes. And importantly, this increase wasn't really driven by widespread defaults actually happening. It was more due to the bank prudently increasing its collectively assessed provisions.
Okay, what does that mean, collectively assessed provisions?
That's a forward-looking measure. The bank uses economic models to estimate potential future losses across the whole portfolio based on forecasts for things like unemployment or GDP growth. So they were essentially setting aside more money in anticipation of a potentially weaker economic outlook down the track, showing a conservative approach to managing risk.
So they were preparing for potential issues down the road, even if they weren't seeing a wave of defaults yet. That sounds like sensible risk management.
Exactly. And that strong credit quality largely continued into FY24. In fact, the impairment charge in the second half actually fell back down to just $175 million, or 4 basis points, suggesting some of those feared losses didn't quite materialize as badly as perhaps anticipated.
Okay, so the sky didn't fall in. But are there any underlying indicators of stress beginning to emerge, particularly as higher rates really bite for households?
Yes, there are. While the headline numbers are good, if you dig a bit deeper, you do see underlying indicators of stress starting to emerge. For example, mortgages that are 90 or more days past due, so people missing 3 or more payments, saw a slight uptick. It rose from 1.0% of the Australian mortgage portfolio in the first half of FY24 to 1.05% in the second half.
Okay, still low but ticking up.
Exactly. Low, but the direction is important. Over the same period, total stressed exposures, which includes not just past due loans, but also loans where the bank sees elevated risk, also rose slightly, from 1.36% to 1.45% of total committed exposures.
And what does that 90-plus days past due figure really mean for an average borrower? And why is that slight increase, even if it's historically low, something for us as observers to watch closely?
Yeah, for an average borrower, being 90-plus days past due means they've missed 3 consecutive months of mortgage payments. It's a significant sign of financial distress. And while these figures, 1.05%, are still very low by historical standards, we saw much higher levels in past downturns, and Westpac's portfolio clearly remains robust overall. This slight increase is a key indicator to watch
Why?
because it signals that the sustained impact of those higher interest rates and broader cost of living pressures is beginning to flow through to a larger, albeit still small, number of borrowers. It suggests that while the overall portfolio is healthy, pockets of stress are definitely forming.
So it's a trend to monitor, not necessarily panic over yet.
Precisely. So what does this all mean? The bank's overall credit health seems good, resilient even. But we are starting to see the expected ripples from those earlier interest rate hikes finally washing ashore. It's looking more like a normalization towards long-term averages, not a looming crisis, but it certainly warrants close ongoing monitoring by the bank and by observers like us.
Got it. Makes sense. Now let's talk about cost management. With all this margin pressure and fierce competition we've discussed, keeping costs under control must be absolutely central to their strategy. Even huge banks have to manage their, household budgets, and technology is often their biggest single expense line.
Cost control is indeed a central pillar of Westpac's strategy, you're right, especially in this kind of environment where revenue growth is harder to come by. Looking back, in FY22, reported operating expenses actually fell quite sharply, by 19%. But this figure was heavily distorted, influenced by notable items related to those business sales we talked about.
So not a true reflection of underlying cost trends.
Not really. On an underlying basis, stripping out those one-offs, expenses were actually largely flat in FY22, which in itself showed some early signs of disciplined management amidst inflation. Then, in FY23, underlying operating expenses rose modestly by about 1% to $10.2 billion. Management did a decent job of largely offsetting inflationary pressures with benefits coming through from their ongoing cost reset efficiency programs.
Okay, so holding the line reasonably well. What about their cost-to-income ratio? That's a key efficiency metric.
Their cost-to-income ratio improved markedly in FY23, down to 49% from 55% the year before. But it's important to note, this improvement was primarily due to that strong revenue recovery we discussed earlier, rather than solely through aggressive cost-cutting on the expense line itself. Revenue grew faster than costs.
Right, the denominator grew faster than the numerator. So revenue growth helped their efficiency ratio more than just outright slashing costs. But in FY24, it sounds like costs started to climb again. What's driving that increase?
Yes, cost pressures definitely became more evident in FY24. Operating expenses in the second half increased by 3% compared to the first half, and this was driven primarily by higher technology costs, things like software licenses, cloud computing costs, vendor expenses, and also by direct investment, increased spending on their multi-year technology simplification program, Unite.
The Unite program again.
Yes. This highlights a crucial strategic trade-off Westpac is making right now. They are firmly in an investment phase. They have to accept higher near-term costs by spending significantly now on technology, particularly the Unite program.
To achieve what long-term?
To achieve the long-term goals of having simpler, more efficient, and more resilient systems. This investment is absolutely critical for their future competitiveness and profitability, especially with that persistent margin pressure we keep seeing. It's a necessary spend, even if it hurts the cost line in the short term, to hopefully remain relevant and efficient in the future.
It's all about investing for the future to hopefully gain that long-term competitive edge and close the gap with someone like CBA. Okay, finally in this section, let's look at the return metrics and capital adequacy. This seems to tell a story of, well, consistent strength for Westpac, especially on the capital front.
It does, particularly on capital, and the return metrics have shown improvement too, which is a testament to their improved operational focus post-OSTRAC and the benefits of simplification. Both profitability and capital strength have improved significantly since the lows around FY22. The bank's return on equity, or ROE, excluding those notable items, rose from an estimated sort of 7.4% in FY22 up to a solid 10.1% in FY23. And they managed to sustain this level into FY24 as well.
And ROE, just to remind listeners, that represents how efficiently a company is using shareholder investments to generate profit, right?
Exactly. So an improving ROE generally signals greater financial health and better management performance. Getting back over 10% was a key milestone for them.
So an improving picture there for profitability for shareholders. And what about capital? Is it still unquestionably strong as APRA demands?
Oh, yes. Their capital position has been a real standout feature throughout this period. The Common Equity Tier 1, or CET1, capital ratio, that key measure of balance sheet strength, has remained robustly above APRO's unquestionably strong benchmark of 10.5%, and also comfortably above Westpac's own target operating range of 11.0% to 11.5%.
What sort of levels have they been running at?
It consistently held above 12% throughout FY23 and FY24. As of March 31st, 2024, it stood at a very strong 12.49%.
Wow, that's quite a buffer above the target range.
It is. This consistently strong capital position, which was significantly bolstered by the capital released from those business divestments we discussed, has been the key enabler of their significant program of capital returns to shareholders, the dividends and buybacks.
Right, which leads to an important question you raised earlier. How does a bank manage to hold so much capital, well above requirements, while also returning significant amounts to shareholders through buybacks and dividends?
Well, it's really a testament to both their robust underlying capital generation from earnings and also their strategic capital management framework. They actively manage their balance sheet to optimize capital efficiency, and the divestments provided a large pool of surplus capital that they decided was best returned to shareholders rather than deployed in lower returning assets.
That's a great point, and it highlights a lot of the strategic decisions the bank has been making over the past few years. Let's now look forward, examining the challenges and the opportunities that lie ahead for Westpac. And look, we really can't talk about Westpac's recent history or future without properly addressing the shadow of the Ostrak settlement. That was just a truly massive event for the bank.
It was indeed a defining moment, and frankly a very low point in Westpac's long history. Back in 2020, Westpac agreed to pay a record $1.3 billion penalty.
$1.3 billion.
Yes, a record for Australia.
Yeah.
And this was for over 23 million individual breaches of the anti-money laundering and counterterrorism financing laws.
23 million breaches. The scale is just mind-boggling.
It is. And the underlying failings were described as systemic and severe. They included things like a failure to properly report over 19.5 million international funds transfers worth over $11 billion over several years. And perhaps most damagingly, critical lapses in monitoring transactions that were potentially linked to child exploitation. These weren't just minor technical breaches, these were fundamental failures.
Terrible. A huge blow to their reputation, let alone the financial penalty. How did they respond? What came out of that in terms of actual remediation?
Well, this event led directly to the creation of the Customer Outcomes and Risk Excellence Program, which they internally called CORE. This was a massive, multi-year effort designed specifically to address the root causes of those compliance failures and fundamentally rebuild their systems, processes, and critically, their culture around risk management and compliance.
A root and branch overhaul, essentially.
Pretty much. The CORE integrated plan, the roadmap for all this work, was formally completed in May 2024. That was a really significant milestone for the bank, and its successful implementation was absolutely pivotal in restoring regulatory confidence. It directly led to APRA, the prudential regulator, agreeing to reduce a punitive operational risk capital overlay that had been imposed on the bank as punishment.
So APRA gave them a tick, basically, a sign that real progress had been made.
A very clear signal of regulatory approval, yes. It showed APRA believes substantive progress had been made in fixing those underlying issues.
So they completed this huge remediation program, CORE. Does that mean the regulatory scrutiny is finally over for Westpac, or is there a longer tail to these kinds of historical issues?
Well, what's fascinating here is, even after a major comprehensive remediation program like CORE is completed, the long tail of regulatory and compliance risk can persist for years afterwards. It doesn't just switch off overnight.
How so?
Well, regulatory scrutiny from ASIC, the corporate and conduct regulator, for instance, remains intense, often focusing on historical issues that predated or ran alongside the Ostrak matters. For example, in September 2023, ASIC initiated new civil penalty proceedings against Westpac. This time alleging a technology failure between 2015 and 2022 led to 229 hardship applications from struggling customers not being properly assessed.
Wow, another tech failure leading to customer harm.
Exactly. Then, in February 2024, the federal court ordered Westpac to pay a $1.8 million penalty for unconscionable conduct relating to a big interest rate swap transaction way back in 2016. And even more recently, in June 2025, their mortgage subsidiary Rams Financial Group reached an agreement with ASIC regarding failures in its oversight of franchisees between 2019 and 2023.
So the hits keep coming, even for past actions.
They do. These actions really underscore that past failings, even those addressed by broad programs like Corp, can lead to further investigations and financial penalties years down the line. It requires perpetual vigilance from the bank, and it demonstrates that fixing problems is an ongoing commitment, not just a one-off project you can close out.
That's a powerful reminder for any large organization, really. These issues can linger for a very long time. Beyond those past compliance issues, what about ongoing operational resilience, particularly when it comes to their technology systems? We just saw a major outage recently, didn't we, affecting customers?
Yes, technology resilience is a constant challenge for all banks, frankly. And indeed, Westpac experienced a significant technology outage back in October 2024. It left customers unable to access online and mobile banking services for a period.
Yeah, that causes huge frustration and disruption when that happens.
Absolutely. We've probably all experienced it with one provider or another. Such incidents really highlight the inherent operational risk that comes with running these incredibly complex banking systems. And that risk is probably amplified during a period of major technology transformation like Westpac is undergoing, where you're decommissioning old legacy platforms and integrating new ones. Things can break.
So is the investment in tech actually helping, or are these outages just inevitable?
Well, despite that high-profile outage, the bank actually reported a 33% reduction in overall technology incidents in FY24 compared to the previous year. So that suggests their significant investment in resilience and modernization is beginning to pay off, even if there are occasional highly visible stumbles along the way. It's about reducing the frequency and impact rather than eliminating risk entirely.
Right, progress, not perfection, perhaps. It sounds like a lot of heavy lifting for the leadership team through all of this. And speaking of leadership, there's been a recent changing of the guard, hasn't there, right, at this really pivotal moment for the bank?
Yes, absolutely. This whole period, from the depths of the Austrac crisis through the core remediation, culminated in a significant leadership transition just recently. Peter King, the CEO who had steered the bank through that crisis and oversaw the core program, retired in September 2024.
Right, he saw them through the worst of it.
He did, and he was succeeded by Anthony Miller, who was previously the chief executive of Westpac's Business and Wealth Division. Miller took over as Group CEO effective December 2024.
Okay, an internal appointment.
Yes, and here's where it gets really interesting, strategically speaking. This leadership transition, combined with the formal completion of the core program, marks a very clear inflection point for Westpac.
An inflection point, how?
Well, the bank's narrative, both internally and externally to the market, is shifting decisively.
Yeah.
It's moving away from a story dominated by fixing past problems and remediation towards one that's much more focused on future growth and, critically, the execution of its strategic technology agenda.
So the focus shifts from defense to offense, almost.
That's a good way to put it. The central question for the market, for investors, has evolved. It's no longer primarily about whether Westpac can resolve its historical risk issues, though ongoing vigilance is needed. The key question now is whether this new leadership team under Anthony Miller can effectively execute the bank's ambitious growth plans and, crucially, deliver on that complex technology strategy.
That's a huge shift in focus, a real turning point for the bank and how it's perceived. And at the heart of that technology strategy is this program they call Unite. This sounds like Westpac's really big bet on its future, truly foundational for everything else.
It absolutely is. You could argue it's the most significant near-term risk and opportunity for Westpac. Unite is a multi-year, multi-billion-dollar overhaul of Westpac's entire technology infrastructure. It's massive.
What's the main goal? What are they trying to achieve?
The core aim is to radically simplify their notoriously complex and fragmented legacy systems. They want to significantly reduce the number of different technology platforms they operate on and create a much more modern, cost-efficient, and resilient technology environment.
Can you give an example of that simplification?
Sure. A key tangible goal within Unite is consolidating 3 separate aging deposit processor systems, the core platforms that manage customer accounts, down into a single modern platform. Imagine the sheer complexity, the risk, and the effort involved in migrating millions of customer accounts and billions of dollars between systems like that.
Yeah, consolidating 3 core banking systems into one sounds like an IT department's ultimate Everest expedition.
Yeah.
But presumably vital for long-term efficiency.
Absolutely vital. And they are committing huge resources to this. Westpac is dedicating a very significant portion of its total investment spending, somewhere between 35% and 40%, just to the Unite program between the financial years 2025 and 2028.
Wow, that's a huge chunk of their investment budget.
Yeah.
What are the stakes involved here?
The stakes are incredibly high. While the program promises substantial long-term benefits, things like significantly lower operating costs, much improved digital capabilities for customers, faster time to market for new products, better data analytics, it carries considerable execution risk.
What kind of execution risk?
Well, analyst commentary consistently highlights the potential for delays, for cost overruns. These huge tech projects are notorious for that, and also the potential negative impacts on profitability during the complex transition period itself. Things might get worse before they get better.
Right.
Success here is absolutely fundamental if Westpac is to close that efficiency gap with its peers, especially CBA. Failure, however, or even significant stumbles, would severely undermine their competitive position, their cost base, and ultimately shareholder value. This Unite program, it's really Westpac's moment of truth on the technology front.
So definitely high risk, but potentially very high reward if they get it right. Alongside this massive tech investment, where else are they looking for more targeted growth and innovation to ensure they're not just playing catch up on costs, but actually aiming to lead in specific areas?
Well, as we touched on earlier, Westpac is strategically prioritizing business lending as a key growth vector alongside defending its mortgage share. And their performance in this business segment has been strong recently. Business lending grew by that impressive 14% in the first half of 2025, which significantly outpaced the 5% growth they saw in their much larger mortgage book over the same period.
Okay, so the focus is yielding results there. What are they actually doing to drive that growth?
They're investing quite heavily to support this ambition. They've announced plans for hiring 200 new specialized business bankers. They're enhancing their digital platforms for business transactions and cash flow management. They're streamlining their lending processes to make it faster and easier for businesses to get credit. And they're aiming for an ambitious 20% return on tangible equity, or OT, for the business and wealth division. ROTE is a key measure of profitability relative to the capital directly invested in that specific business. So targeting 20% shows a real focus on achieving efficient, high-quality growth, not just volume.
That's a clear signal of intent, really trying to move beyond just being seen as a mortgage bank. What kind of innovation are we seeing beyond just faster loan approvals and hiring more bankers? Are they innovating in products or services too?
Yes, innovation also focuses heavily on other areas, particularly security and enhancing customer value, trying to build stickier relationships. On the security front, they're implementing things like real-time payment warnings to alert customers to potentially suspicious transactions before they happen. They've introduced a safer pay alert system for payments to new payees, trying to combat invoice fraud. And they're even developing voice scam detection technology within their app and call centers, aiming to combat the ever-evolving threat of financial crime and scams.
That's important, building trust. What about value add?
For value-added services, they've done things like partner with the cashback platform Shopback, integrating offers into their banking app. And they've also introduced a tool that allows customers to track the estimated carbon footprint of their spending, tying into broader environmental awareness trends.
Interesting. So trying to be more than just a transaction provider.
Exactly. Ultimately, Westpac's strategy right now is a classic simplify and invest turnaround play. The simplify phase, selling off non-core assets and completing the core remediation, is now largely complete. And the invest phase, with the massive Unite program at its core, alongside targeted growth investments in areas like business banking, is now in full swing. Success really hinges on flawless execution over the next few years to deliver on these ambitious goals and truly transform Australia's oldest bank into a modern, efficient digital powerhouse.
Simplify and invest. It sounds straightforward, but the execution is everything. This has been a really comprehensive look at Westpac's journey, its challenges, its strategy, bringing us right up to this critical inflection point. Now let's put on our investor hats for the final part and look at this from a capital and valuation perspective. First off, how has Westpac been rewarding its shareholders during this transformative and at times turbulent period, especially with all that strong capital they've built up?
Westpac has maintained a pretty clear and consistent dividend policy throughout this period. They aim for a payout ratio of between 65% and 75% of their cash earnings, and they've generally delivered within or close to that range. For FY23, for instance, they declared a total fully franked dividend of 142 cents per share. That was a healthy 14% increase on the prior year, representing a payout ratio of 68%, right in the middle of their target range.
And fully franked is important for Australian investors, right? Means
Yeah.
the tax is already paid.
Exactly. The imputation credits attached make the effective yield much higher for many domestic shareholders. Then for FY24, shareholder returns were further enhanced. They paid an ordinary dividend totaling 151 cents per share for the year, which was another 6% increase, representing a payout ratio of 73% towards the top end of their range. And notably, with their first half results in May 2024, they also announced a special dividend of 15 cents per share. This is the first time they'd paid a special dividend since way back in 2013.
Right, a special dividend is usually a pretty clear signal of financial strength and confidence from the board.
Yeah.
Certainly a welcome surprise for investors after a long gap.
Definitely a positive signal. But alongside the dividends, a key feature of their capital return story recently has been the aggressive use of on-market share buybacks.
Ah, yes, buying back their own shares. Why have they been doing that so much?
Well, as we discussed, the capital released from those earlier business divestments, combined with strong organic capital generation from their earnings, pushed their CET1 capital ratio well above their target operating range. They had surplus capital, so they announced a $1.5 billion buyback program in November 2023. Then another $1.0 billion buyback in May 2024, alongside that special dividend. And then another $1 billion buyback announced in November 2024 with their full-year results.
Wow, that adds up. That's $3.5 billion in announced buybacks over roughly a 12-month period.
It is. That's a very substantial return of capital to shareholders. And remember, share buybacks also help to boost earnings per share for the remaining shareholders, as the same profits are spread over fewer shares.
Right, so this aggressive capital return strategy, the dividends and the buybacks, it's been a compelling reason for investors to hold the stock during this operational turnaround phase, hasn't it? Kind of bridging the gap until the full benefits of things like Unite might materialize.
I think that's exactly right. It delivers immediate, tangible returns to shareholders while they wait for the longer-term strategic initiatives to hopefully bear fruit. But this raises that important question again. How sustainable are these substantial shareholder returns, particularly the buybacks, in the long term, once this current pool of surplus capital from divestments is exhausted?
Yeah, future returns will depend much more on ongoing earnings generation and maintaining that capital strength without relying on the one-off gains. That's a crucial point for anyone looking at Westpac as a long-term investment, weighing those attractive short-term returns against future sustainability.
Okay, let's talk about the price tag itself. The valuation. How does Westpac's share price and valuation stack up against its peers like CBA, NAB, and ANZ, and also against its own historical performance? Is the market already pricing in that successful turnaround you mentioned?
That's the million-dollar question, or perhaps the billion-dollar one. Looking at Westpac's valuation on a price-to-earnings, or PE, basis, it does appear somewhat elevated when you compare it to its own history. As of August 2025, its trailing PE ratio was hovering around 19.5 times. That's a noticeable premium to its average PE over the last 10 years, which is closer to 15.2 times.
So more expensive than usual based on past earnings. How does it look compared to the other Big Four banks right now, maybe on a forward-looking basis? Yeah, looking at forward PE estimates, Westpac trades at around 18.1 times expected earnings. Now, this is still a significant discount to CBA, which commands that hefty premium PE of about 26.3 times.
Wow, 26 times for CBA. That always stands out.
It really does. Westpac's 18.1 times is roughly in line with NAB's forward PE of about 17.8 times, but it's at a clear premium to ANZ, which trades on a lower multiple of around 14.3 times. So Westpac sits kind of in the middle of the pack, excluding CBA.
Okay. And you mentioned CBA's premium is largely due to its higher profitability and that perceived tech leadership.
Yeah.
How does Westpac compare on other metrics like price-to-book value?
Yeah, price to book, or PB, which compares the share price to the bank's net asset value per share, tells a similar story. Westpac's PB ratio is approximately 1.5 times. Again, this is a significant discount to CBA's exceptional PB of around 3.6 times. Investors are willing to pay 3.6 times the book value for CBA's perceived quality and returns.
3.6. Amazing.
It is. Westpac's 1.5 times PB is broadly similar to ANZ's 1.38 times, but it's noticeably below NA's PB of around 2.05 times. And generally, these price-to-book gaps between the banks tend to correlate fairly well with their respective return on equity figures. Higher ROE usually justifies a higher PB multiple.
So the market seems to be ranking them CBA, then NE, then Westpac and ANZ fairly closely on that PB metric, which reflects their profitability.
Broadly speaking, yes. It's a clear market signal about who is currently delivering the most efficient returns relative to their asset base.
Okay. And what about the dividend yield? for those investors focused purely on income. Is Westpac still competitive there, even with the share price having run up a bit?
Westpac's forward dividend yield based on expected dividends is approximately 3.9%. Now, that is competitive within the peer group. It's significantly higher than CBA's relatively low yield of 3.0% because CBA's share price is so high. But Westpac's yield is slightly lower than NA's expected yield of 4.1% and ANZ's 4.9%.
So decent, but maybe not the highest yield on offer.
Decent, yes. And remember, when you factor in the value of Australia's dividend imputation system, that grossed-up yield becomes significantly higher for eligible domestic investors, making it still an attractive source of income for many.
Right. So if we connect all this valuation discussion to the bigger picture, what's the main takeaway?
The main takeaway seems to be that the market is pricing in a fairly successful operational turnaround for Westpac, even before all the benefits, particularly from the Unite program, have been fully realized and proven. In fact, a lot of analyst commentary recently suggests that the entire Australian banking sector has seen a significant re-rating upwards. Some analysts are describing valuations across the board as demanding or even frothy.
Frothy, why?
Well, partly it's due to strong demand from passive index funds that just have to own the big banks, and maybe some momentum trading as well. But organizations like Morningstar, for instance, have recently viewed Westpac shares as being perhaps more than 15% overvalued compared to their estimate of fair value.
15% overvalued.
That's their view. It suggests the market's current optimism might be running a little ahead of the bank's fundamental progress, creating potential valuation risk.
So the market is optimistic, perhaps even a little too optimistic, creating that tightrope walk for Westpac we talked about. This leads us perfectly to the final piece, the key risks. Where could this investment thesis falter for Westpac? What should investors be most wary of?
Yeah, based on everything we've discussed, I think there are three primary risks that could materially impact the investment thesis and Westpac's performance going forward. The first, and arguably the most significant and immediate, is execution risk, specifically around the Unite program.
That tech overhaul again.
Exactly. The entire investment case, the path to better efficiency and competitiveness, is heavily predicated on the successful, on-time, and importantly, on-budget delivery of that multi-billion-dollar Unite technology transformation. Any material delays, significant cost overruns, or perhaps worst of all, a failure to actually deliver the projected efficiency gains and improved capabilities after all that spending would severely undermine the bank's ability to improve its competitive cost position. And it would almost certainly lead to a negative market reaction. It's a massive, incredibly complex transformation that requires near-flawless delivery over several years.
So that tech overhaul really is everything. It has to work. What's the next big risk the bank faces?
The second major risk category is macroeconomic risk. We've seen resilience so far, but a severe deterioration in the Australian economy would still pose a significant threat. If we saw a significant rise in unemployment or a sharp, sustained fall in property prices, that would naturally lead to materially higher credit losses for all banks, including Westpac.
And Westpac is particularly exposed due to its large mortgage book.
Yes, given the concentration of Westpac's loan book in Australian mortgages and consumer lending, such a scenario would have a direct and very negative impact on their earnings and potentially their capital position. While the loan book has shown resilience so far, a truly systemic economic shock would certainly test that strength severely.
Okay. Execution risk, macroeconomic risk. And the third risk, I imagine, has something to do with that potentially frothy valuation you just mentioned, particularly if the market's optimism proves unfounded or sentiment changes.
Precisely. The third key risk is valuation risk. As we noted, the bank shares are currently trading at a valuation premium to their own long-term historical average, suggesting that a successful operational turnaround and the benefits of Unite are already largely priced into the current share price.
Leaving little room for error.
Exactly. This leaves little room for error or disappointment. If the execution of the bank's strategy falters, maybe Unite hits major roadblocks, or even if the broader market simply decides to derate the banking sector from its current elevated multiples for some reason, Westpac's share price could be vulnerable to a significant correction. The higher you fly, the further you can fall.
Right. So what does this all mean for you, the listener, the learner, maybe the potential investor? It really underscores that it's all about how these significant risks, execution, macro valuation balance against the potential opportunities from the turnaround strategy. Westpac is undeniably in a pivotal moment, and while the potential rewards are certainly there if they succeed, so are significant hurdles that demand very careful consideration. #outro. Wow. What an incredible journey we've taken through Westpac's recent history and its really ambitious path forward. We've journeyed through Westpac's transformation, haven't we? From fixing those very significant past problems to now betting big on its future.
It's been quite the narrative arc.
Definitely. From overcoming those huge regulatory hurdles, the Austrac settlement, the Corp program, to embarking on this incredibly ambitious digital transformation with Unite, Westpac has certainly been busy. We've seen its financial resilience come through, its strong capital position being a key feature, and its clear commitment to shareholder returns, especially recently, all while navigating that intense competition and a really dynamic economic environment.
Yeah, to reiterate, Westpac is truly an institution at a pivotal moment. The narrative, as we said, has clearly shifted. It's moved from one of intensive remediation and fixing the past to one focused squarely on driving future growth and efficiency. Its success in the coming years really hinges on, I think, two key things: the flawless execution of that multi-billion-dollar Unite technology overhaul and its ability to successfully capture growth in key areas like business lending while simultaneously defending its core mortgage franchise in that tough market. It's a story of an old giant needing to reinvent itself for a new digital era.
And that leaves us with a provocative thought for you, our listener, to consider. In a world that's increasingly driven by instant digital interactions, by agile competitors who were born digital, how much does Australia's oldest bank need to shed its complex legacy systems, and maybe even its legacy thinking, to truly compete with the disruptors? And what does that whole dynamic mean for the future of financial services as we know it?
And this raises an important question, too. When does the sheer cost and risk of modernizing these massive, complex institutions potentially outweigh the risks of just trying to muddle through or staying behind? And how do we, as customers, as observers, maybe as investors, measure that incredibly difficult trade-off? It's not just about financial terms, is it? It's also about trust, about relevance, about customer experience.
Absolutely. Something to ponder. Keep a close eye on Westpac, especially the progress or lack thereof of its Unite program and those ongoing market share battles in business lending and mortgages. It's going to be fascinating to watch. Thanks for joining us on this deep dive. We'll catch you next time.